All right, good evening, everybody. Thank you again for joining us for our fourth week and our last installment of our insurance recovery webinar series. I thank you very, very much for your attendance. And if you are a repeat, I will do my best to cover the same information we did on Tuesday. Again, please, folks, if there's questions, shoot them to me right away, and I'll make sure that we get to them. As we did last week, we're going to jump into the actual topic, and then I'll go back and do a recap of the policy and how your declarations and just how the claim in general is formatted. But before we do that, I'd like to do as I always do. I am not a professional presenter, so bear with me if there are mistakes, and we will get through this, I promise. Who we are and what we do, I think, is important. Again, first and foremost, we're local. We are the largest adjusting firm in Colorado. We are based in Westminster and have been representing the interests of the local community for 30 plus years. We're part of the largest and most respected adjustment company in the entire country. And with our partnerships in the West and our Pacific Northwest, we have allocated about 100 employees, as I've mentioned before, to this particular event, consisting of adjusters and estimating professionals, contents professionals, and so on. We've represented thousands of Wildfire clients, and the lens that we look at your claim through is through the lens of an adjuster. We are your advocate. We are licensed by the Department of Insurance. Our technical term is called a public adjuster. And we work for you. We don't work for the insurance company. So all the advice that I give or that we give as a company is based off how we know the insurance companies are expected to respond, what you are entitled to, and to give you a little bit better understanding as to how to navigate your claim moving forward as you travel down this very difficult path. So with that, we'll just jump into this evening's subject, which is rebuild versus buy. We had quite a few questions after the webinar on Tuesday. So I'm just going to go through and do a recap again. It might be a little bit different, but overall it's going to be the same general information. How do I ensure I do not leave money on the table? Well, first and foremost, folks, remember you are in the middle of a negotiation. This is a how do you interpret your claim kind of thing. And the more you know and the better prepared you are as you approach your claim, and the more knowledge you have and understanding how the adjuster and the insurance company is going to strategically position themselves, then the more control you're going to have over that. First and foremost, folks, do not talk to the insurance company about your goals. They are the ones holding the checkbook, and they are also the ones that can put the roadblocks in front of you. And they are also going to take you down a very scripted path, and that path is loaded with landmines, and you don't know where the mines are. So the more information you give them, the better they can then position themselves to stop you from going down that path, especially if that path is going to represent a much larger financial obligation on their part. So you're always best to reach out to professionals, be it firms like ours, attorneys, openly discuss what it is that you're attempting to do, letting us review your policy and kind of show you how the policy may respond to that particular path, and at least get some options and understand how to position yourself accordingly so that you're not finding yourself in a very reactive role to the carrier's position, because you definitely don't want to telegraph your position. Don't step on the landmines. Understand that what you say may impact your recovery. Folks, everything that you say in a claim goes on record. That adjuster is feverishly typing every word that you say when you're having conversations and you're on the phone with them. That way it goes into your file. Every question that the insurance company asks you, folks, there is a reason for that. And they may ask that same question in a different way 3 months down the line. And if you answer that question differently, they might come and say, hey, were you being dishonest when we asked you the question the first time, or are you being dishonest now because you've given us two different answers? So you want to be very specific about your communication. We recommend that you always communicate in writing. I've had a lot of clients recently that are talking about not clients that we're actually representing, but just people who have reached out to us, and they are telling me that their adjuster is texting them quite a bit. Folks, texting does not make it to your file. So any commitments that you might be getting from your adjuster, any conversations that you might be having are totally void of your file, that don't make it into your file. So be careful when you're communicating. I can't stress enough. Everything you do needs to be in writing. Document your claim like you're going to court, and make sure that you pin them down in your emails for specific direct answers. And when you do have a telephone conversation, make sure you memorialize that conversation in a recap email, just to make sure that that information makes it to your file. Again, meet with a claims consultant, explore your options, an attorney, a public adjusting firm, someone intimately familiar with negotiating claims, because you may have 5 different options available to you. And, our job is to kind of explore all these options for you, and you can kind of see which one fits you the best. Do you rebuild? Well, that depends on your overall goal. And I think that your policy will dictate that goal. There's a lot that you need to take into consideration. For example, do you have a mortgage? If so, what's the balance? Because the balance of your mortgage is going to play a role, folks. If you have $300,000 or $400,000 or $500,000 balance on your mortgage, when you look at paying off your mortgage, you really want to take a look at paying off the lot. That's what you're doing. You're not paying it off with a house on it. You're paying a very specific dollar amount to own a lot that is not in the same condition it was when you purchased it. So in the market today, yes, we've seen a lot of lots go on the market. And as I was having a conversation with someone yesterday, I think that some of these numbers might be a little inflated right now, but I'm not a real estate professional, but I think things are going to take off for a little bit. And then I think they're going to level out when the demand kind of settles down. A lot of it has to do with what is going to happen in your particular neighborhood. If you've lost 20 homes in your neighborhood and only 10 are going to rebuild, then the value of your land isn't probably going to be as much as if there were 15 people rebuilding in your neighborhood, because now that lot becomes more premium. So I think that understanding how you navigate all the numbers and really laying everything out on paper and determining, does it make sense? If I have this mortgage, if I have the balance of this mortgage, do you want to utilize that money and have it allocated back to you for your reconstruction? So typically, folks, which I didn't really get into, when you have a mortgage and there's a balance of on that mortgage, they can only hold the amount of insurable interest that they have against your claim. So if you have a $300,000 balance and you're getting a $600,000 settlement offer from the insurance company, you want to reach out to the bank and you want to make sure, first and foremost, have you notified the financial institution that you had a fire and that your home is gone? First and foremost, they need to know, because they technically own the property until you pay it off. So they want to know that their asset is being rebuilt or their asset is going to be paid off. Either way, you need to communicate with your financial institution. Secondly, when you do communicate with your institution, you want to ask them, what are their protocols in releasing monies back to you? Because again, if they're getting a check that has your name on it and their name on it, and that check is larger than the amount of the balance of your mortgage, you want to know what happens to the balance of that money. It should be in your account working for you, not the bank's account working for them. So you want to know what their protocol is in releasing those funds. Now, typically, the bank will hold on to that money like a standard construction loan. And when you enter into a contract with your contractor, they will release those monies back to you in thirds. But I call them phases. Phase 1 is to get the project started. And then when you're 50% through phase 1 and your contractor comes back and says, Mr. and Mrs. Smith, it's time for the second installment, we need more money, you would then reach out to the bank. The bank may send out an inspector just to take a look and make sure that the progress is what it should be for phase 1 and that the monies that were allocated have been spent accordingly. And then they will release phase 2 money, and same for phase 3. So certainly want to make sure you've got an understanding as to how the bank is going to apply these monies. Does it make sense to leverage the balance of your mortgage and put it back into your property and rebuild? Do you have to go back with the same structure? And that takes me right into what are your restrictions, right? The bank may have some very specific restrictions. They may want exactly what they financed. They may have some pretty strong input as to what they want to see on that asset. You may not want the bank looking over your shoulder. So again, it goes back to the balance. If you've got a small balance and maybe you can repurpose some of your personal property monies to pay off that mortgage, and now you're free and clear and you want to move elsewhere potentially and start a new life in a different part of town or a different state and hold on to the lot, see what happens with the market, and then turn around and sell it down the road if you choose. But folks, time is going to dictate everything right now. So you don't have to rush into things. I think that the more people understand when they start to hit these roadblocks with the settlement offers that they're getting, and you start to see a lot of these larger communities that have lost their homes not having the money that they need to go back and rebuild right away because they don't have a negotiated settlement, it's going to slow things down. Right now, things have been going fast because the carriers are obligated to perform in the first 30 days, and a lot of them have done so. And now things are going to start to taper off, and you're going to start to see the communication start to fall off. And there's not going to be a sense of urgency that you once felt with the insurance company. Code, we've discussed this on many occasions in the past with the way that the claim breaks down. Most people have a code upgrade in their policy, or they have some form of code coverage. Does it transfer if you don't rebuild? Well, folks, it's a policy specific situation. Some very specific language will state that the code does not move with you should you try to buy or build elsewhere. It's very specific to building on site, and then the code would then transfer to your build as necessary. So is it important? Well, how might that affect your recovery? It's important if it seems to be a large number and you're going to have to reallocate some of your other monies, whether it's from your other structures or part of your personal property, your trees, plants, and shrubs, whatever the money is that you're going to, rob Peter to pay Paul with. It could be impactful if you are trying to move elsewhere and the policy doesn't allow you to transfer the code. So again, folks, you've got to take all the variables into account, put everything out on paper, and really forensically understand what your decision or how your decision may impact you in the big financial picture. So the only way to really understand that, you've got to have a forensic understanding of that policy. You have to understand how the different buckets of money are going to apply. And then you have to take your scenario and apply it to those options and understand where you might be exposing yourself to some pretty large financial expenditures. If you buy instead of rebuild, how do I structure the deal? What upfront commitments are needed? Well, this is the most difficult question, I think, in this whole series. And it's because I'm torn when I give you the answer. I'm giving you an answer as an advocate. And I know what you folks don't know, or we know what you folks don't know, because we're negotiating these claims every day. I cannot stress the importance of getting a financial commitment in place with your insurance company in writing. As I've said, almost every single one of our webinars, it is virtually impossible for you to move into a large financial commitment without a full understanding of the exact dollar amount that your insurance company is committing to pay you. And when they have vague language, such as, well, when you get your contractor and we get the estimate, we'll review the estimate and then we'll address those issues as we go. That's not a very comforting feeling, knowing that maybe you got up to your policy limit and then they depreciated that limit and now you're under your policy limit. You haven't even tapped into your extension yet. And that extension could represent $200,000, $300,000, $400,000, $500,000 in recovery, but yet you're expected to make these big committed decisions as to whether you're rebuilding or buying, and yet the insurance company is not committing what their position is going to be financially. And they don't say that they're going to agree to pay you that. Because if that was the case, then you should have a settlement offer right out of the gate. You should have an email from the insurance company that says, we're agreeing to pay you your policy limit and your full extension. And you folks aren't getting that. Some of you have been very lucky and have gotten some policy limits and the extensions. But that's far and few between, and that's carrier specific. So if you buy instead of rebuild, you have to weigh the pros and the cons. You have to get the carrier committed to the monies. You have to understand, how does my extension going to play a role in my purchase? And what happens when I'm transferring those monies over at the end of when I'm trying to close on the property? How do I get that money? You want it broken down, folks. You want it very specific. You want to pin them down. You want to ask very pointed questions. Remember, the insurance company is not here to be your friend, folks. They're here to make you whole. And you need to protect yourself because nobody else is going to protect you, right? You need to be aggressive in your approach to the monies. Let me rephrase that. You need to be assertive, not aggressive. But certainly you want to make sure that you're making your point and that you want specific answers. And I think you'll find that the answers you folks are going to get are going to be very vague, very open-ended, because they don't like to be committed to a specific position. With that, let's just jump to the next slide here. What risks are there if I downsize? Well, that's also a risk, and a lot of you might be intending to do so. Maybe some of you are going from a 2-story to a 1-story. Maybe you are wanting to take your 4,000 square feet that you're entitled to be paid for, and you want to do 2 structures on your property because you have enough land, a 2,000 square foot property and another 2,000 square foot property. That's not how it works, unfortunately. You want to get the commitment again from the carrier. You want to make sure that you've had open dialogue after, folks, you understand what your coverages are, and after you've explored your options, and after you understand the position the carrier could take depending on the position that you intend to take. So just like anything else, just like I've said before in the past, it's a chess game. You want to be 2 or 3 moves ahead of the carrier, and you want to position yourself, but you need to do so like you're negotiating a massive financial settlement, because this is what this is. So you need to understand, if I do this, what is the carrier going to do? So defining your goal, understanding how the policy is going to respond to that goal, making sure you're closing all the doors that they can use as an exit, committing them or making them commit to you what their financial commitment is in writing, and helping you better understand what their role is going to be moving forward when they're holding the checkbook for, in many cases, a pretty large outstanding balance that they owe you. You want to be very careful about the approach. You can certainly just have general conversations to feel them out and not allude to the fact that you might be considering to downsize. But the example that we give here, the client had a 3,000 square foot home. They decided to build a 2,000 and a 1,000 for their mother-in-law, and over their mother and father-in-law, and the carrier tried to decline the 1,000 square foot build. And there's a lot of reasons for that, folks, because remember, you are entitled to, just in simplistic forms, what you had 5 minutes prior to the loss. You're not entitled to anything more, but you're certainly not entitled to anything less. So fine-tuning that and getting the carrier committed to what that is, you certainly don't want to leave it up to them to interpret what that is. You want to dictate what that is to them. So, for example, let's say that you're going with a larger footprint because you're going with a single story instead of a 2-story. So yes, maybe you had a 3,000 square foot house and it was 1,500 and 1,500. And now you want to go 3,000 square feet. You want to do a ranch style single level. Okay, well, that's great. Well, how does the policy respond to that? How does the code upgrade potentially respond to that? Your foundation is going to be quite a bit more because your square footage has now increased. There's going to be a lot of offsetting costs for engineering and whatnot, because now you're not engineering one floor to support the weight of a second floor. But nonetheless, you want to understand the pros and the cons, what the expense may be, and more importantly, how does that decision potentially expose you financially, and how is the code, if you have that coverage, going to respond to that particular decision? Because remember, they only owe you for what you had. And if what you're trying to build is going to trigger a tremendous amount of code just based off the type of construction, that can become very problematic. Decisions impacting your future, or my future. Well, folks, again, I've said it a million times. The thing that I think most people don't have a tendency to put the appropriate value on is the quality of life and time, because that, in my personal opinion, is our most valued commodity. It is one that we do not get back. And in our end days, we are not wishing we had more money in the bank. We're wishing we had more time. So this is a very traumatic event. And for many of you, it is a life-changing event. And you are at the age where you need to make some life-altering decisions. And these decisions are second half of your life decisions. And so that takes the amount of commitment to sit down and really understand how are these decisions going to impact the second half of your life as you move forward from this. You can't be overeducated, I can tell you that. And you certainly can't overexplore your options, but you can certainly underexplore your options, and that can expose you. So the more you know, the more power you have, the better you can recognize the red flags, the better you can strategically position yourself. And that is what we're here for, folks. Reach out and ask the questions. That's what we want to do. We want to give you all of the information that you need to help you make these types of decisions. When you're looking at this, time required versus time available. Again, folks, taking things into consideration, your health, taking things into consideration if you're at retirement age. Do you want to spend the next 2 years, potentially 3 years, managing a project like this to rebuild? I can't answer those questions, only you can, but certainly needs to be taken into account, because the amount of time that is required to properly manage a claim, we're not even talking about the rebuild side of it, folks. We're talking about just the front end management to get you to the point where you can actually hold this money in your hand and then spend it for the decision that you intend to make. You've got to really prepare yourself on the front end so that you're successful on the back end. It takes a tremendous amount of time. And some people just don't have that time for multiple reasons: kids, family, work, whatever it may be. You certainly want to prepare for the uphill battle, because now that the carriers have made their position clear, now that they've paid you the advances, and people are starting to understand that there's a little bit more work involved than just submitting a simple little list or having a conversation about policy limits, you're now starting the uphill battle. So again, prepare accordingly. And the only way you can truly prepare is really two paths of recovery. One is to really get yourself educated, or to consider, depending on the size of your loss and again, what you intend to do, if representation of any kind of advocacy, not just public adjusting, but attorneys or anyone else that's in this industry, if it makes sense for you. But you certainly want to reach out and start asking some pointed questions. Then the last, I think, is you want to secure all of your financial commitments in writing. A lot of people are hearing about their personal property, and they're trying to talk to them about category inventories. Or if they don't want to do the category inventory, they can do a line item inventory. Or if you don't want to submit any inventory to us and you just want to take the 30 or 70 or 80% as an advance and just walk away. Folks, I've had many conversations. Some of you, you made out okay. You don't want to poke the sleeping dog because the advance they gave you may be more than what you've had in the house. And that's okay. That's the advance, and that's the chances that the insurance company takes. But for the majority, and I would say 90% plus, you're going to need to put in quite a bit of work to get to the finish line to get the monies that you're entitled to. So again, you want to make sure that anytime you have a conversation with your adjuster, anytime monies are discussed, anytime you're trying to get a pointed answer from them, a specific answer as it relates to your extensions, as it relates to your policy limits, as it relates to trees, anything that has money attached to it for your claim, whatever that category is you're discussing with them, make sure you memorialize that conversation to recap their answers so that it now becomes part of your record and part of your claim, or you get them to respond to you in a committed email format so that you have record of that conversation as well. So either way, you want to make sure you pin it down and it becomes part of your claim. So that way, if in the off chance your adjuster is reassigned, you're not left holding this bag of all these empty commitments that aren't being met because the adjuster that has now been reassigned to you doesn't see anything in your file about all of these conversations that you've had. So now you're starting from scratch, and all that time that we discussed earlier has now been lost, and you're starting all over again. And the insurance company has a right to have you start over. It's just how they do it. They control. And the one thing that they have, folks, that you don't have, and the one thing you want to pay attention to is time. They have time and you don't. Everything you are doing relates to time. The period of restoration, your housing is related to time. Your ability to perform in the timelines you have to perform within, all time driven, folks. So the more you understand front end of your claim, the better control of your time you're going to have, because you can force them to be more responsive to you. If you just sit around and take a reactive role or approach to your claim, you're just letting a lot of valuable time tick away. So you make sure that you stay on them if you're pursuing that money. So we're just going to jump to the carrier or the claims slides here. We've gone over these every single week, and it's just important to go through it again. If there's any questions, certainly feel free to shoot them over. I'm happy to take the time tonight, given this is our last webinar, answer any questions that you may have. And I'll do so in great detail, depending on what you folks want to shoot over. So again, if you took a look at your claim as a pie, this would be the representation of that pie. Every single one of these categories is part of a claim. It will apply to most of you. Dwelling, your basic limit. Most of you have an extended limit for your dwelling. Your personal property, you have replacement costs and actual cash value, which we'll go through again in case you're just joining us for the first time. Separate structures, code upgrades, additional living expenses, otherwise known as ALE, debris removal, and trees, plants, and shrubs. These are all the basic components of a claim in a wildfire event or in a home that's lost due to fire in general. So for this particular example, we're going to talk about coverage A, the dwelling. Now, of course, your dwelling and your declarations page is going to be different. It's going to be specific to your policy, obviously, but in this example, we're going to use $1 million. It's just a base limit. It's also called a stated limit, if you've heard that phrase. And that stated limit is available to you regardless of what you do. They're entitled to pay based off the measurement, of course, if you rebuild on site, if you purchase a replacement property, or if you choose not to rebuild. The dollar amount doesn't change for what they owe you. Built into as an additional amount of money is your debris removal. And everybody's been talking about debris removal. And it is 5% of your dwelling. So in this particular case, 5% of $1 million is 50,000. Is that debris removal available to you? Depending on what you do or don't do, it is available to you regardless of whether you rebuild, whether you purchase a replacement property, or whether you don't rebuild. Landscaping, typically known as trees, plants, and shrubs, folks. It's 5% of your dwelling in most cases. In some cases, it's 2% that I've seen with some carriers, and I have seen it excluded totally on some policies here recently. So majority of you are going to have this. Again, using this example, it would represent $50,000, 5% of your base limit. So, pardon me, whatever your base limit is, you want to just take 5% and go into your policy. The certified copy, which you've heard me mention a million times, folks, the certified copy is critical for you to understanding exactly what your endorsements are and what additional coverages you may have that aren't in your standard template that the insurance company likes to give you. Now, where it starts getting into some different coverages is your extended replacement cost. And depending on what you do, the policy will respond accordingly. If you choose not to rebuild, folks, and the actual cash value, which is the dollar amount that the insurance company is paying you, without you having to perform, that's all you're ever going to get. If you choose not to rebuild, you're walking away from that extension. So depending on what that extension is, you can determine the value and how important it is to your recovery. If you purchase a replacement property, you are entitled to your extended replacement cost endorsement. But again, folks, understanding how that plays a role and how that money is transferred over to that particular option, it's critical that you get it in writing and that they stick to it. And then, of course, if you rebuild on site, you're entitled to your extended replacement cost if you have that endorsement. Additional increases due to declared catastrophe. I've seen only two in all of the policies that we've reviewed. And now I think we're getting close to almost 500 different policies. So it's not a very common additional increase in coverage, but if it is there and you are one of the lucky ones to have it, it can increase your coverage from 50 to 100%, basically doubling your coverage. But I've not yet seen that in many of them, only in 2. And then, of course, you have code upgrade. Code is directly related to the base limit. It is typically 10% as an average across the board in value. Now, if you do not rebuild, code is a use it or lose it bucket of money. Again, folks, you need to pin them down, look at the policy, look at the exclusions, and read the code endorsement. Understand, if you do not rebuild on site, do you still get that endorsement? Yes, you're still rebuilding, but are there specific parameters that you have to rebuild on that same lot? Most likely, your policy is going to tell you that the code is only transferable to the lot that you are rebuilding on where the loss took place. So you want to define that clearly, because again, it goes back to what we said earlier. It can impact you financially if that's a pretty heavy dollar. In this particular case, it's $100,000 that you might be playing with if you had $1 million policy. If you purchase a replacement property, yes, you can transfer in many cases the code to the purchase and bring the property that you are buying up to code if you are entitled to it. So again, you want to have a very specific discussion with your adjuster to make sure that you understand how those monies are being transferred if you're intending to buy a replacement property. We're going to jump to the next slide here, which is your coverage B, other or separate structures. Some of your policies have, for State Farm, it'll say extended dwelling coverage, I believe. It typically represents 10 to 20% of your stated limit. So since in coverage A, as our previous example was $1 million, this represents 10%. Other structures, folks, just be very clear, it does not mean 4 walls and a roof, as some adjusters are trying to allude to. It is the following. All of these fall under other or separate structures: garages, workshops, detached garages, detached fencing, retaining walls, walkways, driveways, patios, sprinklers, exterior lighting, pools, cabanas, on and on. Basically, if you took your home and you just plucked it off the property, anything left remaining on the property typically would fall under other or separate structures. So you can visualize what was there prior to the loss and understand how to better allocate what might be applicable and how it would fall into this particular coverage. Most people, folks, are underinsured in this particular bucket. I would say it's probably a 70-30 split, 70 being underinsured, 30 being insured. If you have larger plots or larger acreage and you're building detached garages or separate shops, you have a tendency to forget to tell the insurance company that you built this product. And so typically something like that would fall under this, and it would be underinsured in the big picture of things if you had to try to replace it. In some cases, the extended replacement cost endorsement that you have for your dwelling will transfer over to your other structures. So you want to see if you have that endorsement. Debris removal is also an additional coverage for your other structures, folks. It represents 5% of that total bucket as well. And of course, code upgrade is also applicable in this coverage as well. 10 to, depending on what endorsement you may have, up to 100%, but most cases 10%. So in this case, even if you had a $100,000 base limit, ultimately you would have $115,000 of coverage available to you. Personal property. It's the one that most people have the most questions about. In this particular case, we're going to use $500,000. Normally your personal property is typically a percentage of your dwelling. But the percentages vary per policy. So in this case, we're just using $500,000 as an example. which would be your base limit or your stated limit, as I've said in the past, built into your personal property, folks. And again, this is why it's critical to get your certified copy. Yes, this information is primarily posted in your template form of the policy, but the certified copy is the one you really want to be paying attention to. You will have sublimits built into your personal property. Sublimits can be business personal property, watercraft, cash, stamps, coins, certain collectibles. So when you're doing your personal property and you're laying out all of your line items, you want to understand how to navigate that narrative appropriately and make sure that you're operating within the parameters of what they consider to be either a sublimit or not, because it could be just as simple as changing the verbiage of a particular item and understanding that you may not want to, pigeonhole yourself into a sublimit just because of what you're calling something, and it might not actually be a sublimit. So you want to be very careful and understand and identify what the sublimit is and make sure you're working around that language. Scheduled items are items that typically are insured independent of all the other items. They're high dollar value items. I've used a piano as an example in the past. If you had a $100,000 piano, you certainly wouldn't want to have that equate to 1/5 of your overall recovery for your home. You would typically want some of your higher dollar items to be insured independent of everything else. Yes, you pay a little bit more of a premium. But in the big picture of things, it really gives you much more money for recovery, and you're pricing those items appropriately. Actual cash value versus replacement cost value. Basically, folks, replacement cost value minus depreciation equals actual cash value. So I'll say that again, because I've had some discussions these last 2 days again about that. Replacement cost minus depreciation equals actual cash value. We're going to jump to the next slide and we'll start using it as an example. Do you need to list every item? Folks, if you want a full recovery, then you should list every single item for multiple reasons. One, there could be tax advantages to show what you may have lost. You may want to talk to your CPA if you have $500,000 in coverage and you have finished your entire personal property and you've come back and you have $850,000 in loss. Well, does that benefit you in some way because you can take a loss this year? Certainly want to talk to your tax professional. But more importantly, what you're trying to do is you're trying to get so far above your personal property limit, even if you have a replacement cost policy, folks, and I'll explain it. When the depreciation is applied, which it will be, the goal is to get that number that they owe you, the actual cash value number, you want that to be at or above your policy limit. I had a conversation with somebody who told me that their adjuster said you better go at least 80%, folks, above your policy limit, because he had the authority to depreciate items up to 80%, which is just ludicrous. But nonetheless, you want to protect yourself in advance. You don't want to submit any product to them partially. You would probably not want to use their real-time system. Some of those are pretty archaic, very difficult to use by design, by the way. And you would probably want a very specific clean format that you are following. You can turn in your personal property in any format that you choose. We do personal properties and we only use one format, and we don't really care what the insurance companies want. That's what we're giving to them and they have to take it. So if you're interested in understanding how to maybe format your personal property, please reach out to us. We're happy to give you a sample of an inventory we would produce specifically so that you can see the spreadsheet and understand how much data you need to put into your inventory lists to ensure that you're getting what you're entitled to. And then also, again, which I've offered in the past, we have amazing whole house guides, which are about 90 plus pages of items you typically find in a home. It helps jog your memory. It has about, I don't know, almost 4,000 different line items in it. And it really does help you go through the different rooms, the bathrooms, the linen closets, the garages, and just kind of understand what you may have had, and it helps jog the memory. So we're happy to give you that as a courtesy as well. So if that's something you're interested in, please reach out. What is holdback and how does it work? Well, here's how it works, folks. If you have a $1,000 couch and the insurance company wants to depreciate that couch by 50%, they will give you $500 for that couch up front. And then when you replace that couch and you give them the receipt for $1,000, they will give you that recoverable depreciation back. That is not what you want to do, folks. I'm telling you, you do not want to play the receipt game with your insurance company over the next 3 years. Think about the tracking and think about the amount of personal property that you are not going to replace. And that is why, folks, if you look at the strategic position, this is a business you're dealing with. Why do you think the insurance companies give you 30%? A, because they're supposed to, right? Okay, great. That's an easy answer. But what's the strategic position behind it? What's the business advantage as to why they give you these advances? Well, let's talk about it for a quick second. Since it's our last webinar, we'll go into a little more detail. Sorry, Jay. Let's talk about that for a second. So if I'm the insurance company and I roll the dice and I say, I'm going to give you 30%, and then you're going to have to perform. You're not starting at the 30% and then working your way up beyond that. Your inventory that you're submitting to them, folks, is starting from $1. You have to first justify that 30% or whatever the advantage, the advance is, input your own percentage that you've been given. So you still have to start at $1. You have to do the inventory to first justify the advance. And then in order for you to get $1 more, you've got to go through the stratosphere to get to the absolute end of the road to make sure you're capturing everything that you're entitled to. If I'm the insurance company and I put a lot of stress on you and I put a lot of requirements of all this information that I request of you, which by the way, folks, you don't have to do, how are you supposed to know who gave you a wedding gift 40 years ago? How are you going to know that? How are you going to have any documentation on something you've been married for 35 or 40 years? It's unrealistic to expect that. But they put these unrealistic expectations on you because it induces anxiety. And the more stress you feel and the more anxiety ridden you feel, the more you're willing to give up because it's just too much. And you start to have these self-imposed timelines and you're putting all this pressure on yourself to get it done. The reality is you've got a couple of years to get it done, folks. So it doesn't have to be done tonight. It doesn't have to be done next week. Take your time. Do it in small bite-sized pieces. Work on it an hour a night if you're going to do it on your own. And then put it away. Take the weekends off. 1 hour a night, controlled little segments, things you can manage, and don't overdo it. Because when you start jumping into this rabbit hole and trying to do too much too fast, that's when it becomes overwhelming. But that's what the insurance companies are hoping for. So even if you get double the amount that they gave you at 60%, let's say, because you put in your work and now you're getting double what the insurance company gave you as an advance, they still save 40%, folks. You got to look at the big picture. The big picture. It's not just a little advance. It's what's the big picture and how do I get to the finish line and what do I need to do to get so far beyond my limit that I get my policy limit? Because you certainly don't want to find yourself having to keep submitting receipts to them for what you've purchased when you move into your new home or by the time it's rebuilt. So in this particular example, which we've used before, I'm just going to use the women's jeans by Ryder's Vintage. They were $100 in today's market to replace that pair of jeans. The source would be Macy's. The depreciation, I had a question asked, is there a chart for depreciation? No, folks, depreciation is totally subjective and it's based off age, condition, and useful obsolescence. So you can certainly dictate what the percentage of your depreciation should be by way of how detailed your description is about that line item. Again, you want to leave nothing up to the insurance company to interpret. You want to make your position crystal clear so that they're forced to deal with that data. The actual cash value is the dollar amount that they will pay you for that particular line item, because remember, it's replacement cost minus depreciation equals actual cash value. So they will withhold that $50 in depreciation. And when you spend $100 to replace those jeans and give them the receipt, which again, you don't want to do, they will give you back that $50 in recoverable depreciation. So that's how that works across the board. Inventory tips and tools. Keep a pad and pen with you at all times. Draw each room out one by one from an aerial perspective and put the big pieces of furniture, go up the walls, go down the walls, break your rooms out into small quadrants and work clockwise in that small quadrant. Basically break the room down into 4 and work little sections. It focuses your brain differently. Visualize all the drawers, the bureaus, the closets, the shelves, the under the bed. Don't forget what was in the dressers. Use family and friends, folks. We're starting to see a lot more of that. Download the Dropbox app. Have all your friends start just dumping pictures from past Christmases and Thanksgivings and Easters if you have them. Everybody's got pictures and everybody's willing to help. And it certainly relieves a tremendous amount of stress when somebody is given a small 5 or 10 line items and your family members can look up the replacement cost for those items and print everything out that generates that pricing and then gives it back to you, because that's just less time you have to take looking for things online to determine the value of what you've lost. The photograph documentation and the cloud storage is critical, folks. Everybody really, you should be digging into all your pictures, because your personal property is in the background of those pictures. The finishes, if you have any dispute based off the estimate that you finally get back with your settlement, and you're going through each one of the line items with a fine-tooth comb to see where your adjuster was wrong, you can now use these pictures as a guide to show them, which is documentation to say, hey, I had 6-inch crown molding, not 4-inch crown molding. I had beautiful marble, not granite, whatever the case may be. But you want to be able to show them in the background what that might be to support your position. Loss of use, additional living expense versus fair rental value, folks. Additional living expenses, otherwise known as ALE, which we mentioned in the very first slide, covers your temporary housing while you're displaced, your furniture rental while you are in your temporary home, increased mileage if you have to travel further to and from based off where your temp house is and where you end up landing. You are entitled to mileage and potential gas. RV or boat storage. If you once had an area where you could store these items and you no longer can, and now you're having to pay for this particular expense, you should have a discussion with your insurance company about covering that expense. It's a cost that you are incurring that you would have not otherwise incurred had you not suffered a loss. Animal boarding, same thing. We have some clients that own horses that are being boarded elsewhere. The cost is something that could and should be written off by the insurance company and covered. Additional living expenses is typically driven by either a dollar limit in your policy or an amount of time. If it's an amount of time and there's nothing there, in many cases it'll say ALS or actual loss sustained, which just means that whatever the cost is in order to house you based off what the value of your home would have rented for, excuse me, folks, then that's the dollar amount that they will allocate per month. That takes me right into the fair rental value. Fair rental value is what your home would have rented for prior to the fire. So if, let's say, you had a 2,800 or 3,000 square foot home and furnished in the market, it would have pulled $6,000, $7,000 as a rental. That's typically what you're entitled to. The carrier is, they do owe for increased costs due to limited housing. So we are having a tremendous surge in temporary housing right now. And we're working with a lot of different companies outside of the vendors that the insurance company is using that have been fantastic in finding replacement properties for families that are right in the price range of what the insurance company should be paying and what they should be allocating. So if you are getting a $2,000 a month allocation, because that's what the insurance company is saying that you're owed, immediately, folks, challenge that position. Because remember, this is, you need to protect yourself. Nobody's going to protect you unless you have your own advocate doing it for you. So if you're going about this on your own, you need to challenge everything. So when they give you a dollar amount that they're going to pay per month, you want to challenge that position and ask them for the data. What is the data that is generating this financial dollar? If it doesn't apply and it's not accurate, then push back, find your own data, look at what things you're renting for right now. Get on Zillow, get on Redfin, get on the different sites that are showing what properties are available and how much they're going for. Present your case and prove to the insurance company what you're owed, folks. You have to defend yourself. People don't understand that when you have a policy and you have coverages in your policy, it's not the insurance company's obligation to make sure that you're made whole. It's your obligation to make sure that you're made whole. You have to prove the value of your loss to the insurance company because you're filing the claim against them. They're just giving you their interpretation of your loss. So you need to challenge every position and push back with every single bucket unless you're getting that actual check in your hand as cash for the policy limit for whatever that coverage is. So again, fair rental value. What that means sometimes is that most people who have fair rental value will take the check and then they will be they'll have to find their own housing and then allocate that money that they get every month. Now the carrier can come back to you in 3 or 6 months and say, show me the lease, show me what you've been spending the money on, because they want to make sure that the dollar amount that they're giving you is what you're allocating to your housing each month. If they give you 7,000 and you're only using 3,000 and you're putting 4,000 away in the bank, just be prepared, folks, that if they come back and say, show us what you're spending your money on, and you haven't spent all that money on housing, they could withhold your housing monies and then force you to consume based off what they've paid you towards your housing before they'll issue you any more money. So that's how your loss of use works. We've gone through these. So who can represent you? Again, folks, attorneys certainly can represent you. As I've said before, they take a very proactive or reactive approach. They wait for the insurance company to kind of take a position. We have attorneys on staff, even though we don't practice law. We believe that being more proactive in your approach and controlling the upfront narrative will dictate the back end success. So certainly public adjusters like myself, our firm, other public adjusters in general, you certainly wouldn't want to rely on a contractor. The insurance company does not have to take your contractor's numbers into consideration. Again, problematic, especially if that contractor is looking at your loss through their business lens and their reconstructive cost is out of line. That can become a problem for you. Insurance agents and brokers, they sell you the product. Yes, they're licensed by the Department of Insurance like we are, but we are licensed to negotiate those products. They are licensed to sell the product. Typically, agents and brokers will not get involved in your claim because that's not what they do, just like we don't sell policies. So I think I've kind of covered everything at this point. I want to thank you folks again for hanging out with us for the last 4 weeks. I hope that you have found it somewhat helpful. I hope that you were able to pull some nuggets of information. I hope it empowers you to some degree to manage the claim on your own. If you would be so inclined to express yourself in your local social media, if there's Slack or Nextdoor or Facebook, and you think that somebody could benefit from having a meeting with us, we're more than happy to sit down with you folks. As I've mentioned before, go through and do forensic policy reviews, give you different ways of looking at your claim, help you better strategize as you move forward, understand what might be coming so that you can prepare accordingly. I thank you all for your time. I'm so sorry for all of your loss. I hope that everyone recovers. And again, please feel free to reach out to us if you have any questions. We wish you well and a speedy recovery. Thank you for joining us.